Hello and welcome to Macro by Kixelius. After keeping its 10-year interest rate target at zero for more than 6 years to boost the Japanese economy, the Bank of Japan relaxed its interest rate cap in December 2022 to allow the 10-year rate to rise to 50 basis points versus 25 basis points prior. Many investors extrapolated this as the first of many hawkish decisions to come, and the yen staged a powerful rebound. Despite market consensus of further yen strength ahead, there are reasons to be cautious. The latest move was not the first time the Bank of Japan relaxed its 10-year trading band. After launching its yield curve control policy in September 2016, there were two prior changes to the interest rate cap. In July 2018, the policy board expanded the 10-year trading band from 10 to 20 basis points above and below the 10-year interest rate target, and then to 25 basis points in March 2021. Subsequent BOJ intervention cheapened the yen when market tested policy ceiling in 2022. It can happen again when rising bond yields approach 50 basis points. The yen is highly reactive to Japan's interest rate cap due to mechanics of Bank of Japan's intervention. As investors sell Japanese bonds to push up interest rates, the Bank of Japan will print money to buy back bonds and fight against the market force. In the process, the yen will become a casualty of unlimited money printing to keep interest rates low. The more forcefully the Bank of Japan defends its line on the sand, the more yen it will print out of the thin air to buy back bonds. As markets become fearful of consequences of debt monetization, institutions will sell yen to avoid losses. There's no free lunch in markets, and there's no costless intervention. Amid China's economic reopening, revived growth and higher commodity prices will boost inflation. In the UK, fiscal stimulus replaced talks of austerity, and energy subsidy to businesses will continue into spring 2024. Japan's economy is sensitive to global commodity prices, and a cost spike could lift domestic inflation and exert upward pressure to its 10-year government bond yield. At the same time, cold movements in global long-term interest rates will also push Japan's 10-year interest rate toward a BOJ rate cap, forcing the central bank to transfer weakness from the bonds to the yen. The Japanese yen has strengthened to price in further hawkish policies by the Bank of Japan, but it may not materialize until the second quarter. In the meantime, higher than expected global inflation and better growth outlook will risk lifting Japan's interest rates and force the Bank of Japan to intervene by capping interest rates using money printing. Under this scenario, the yen will face further downside risk. Thank you for watching, and I will see you at the next episode. Thanks to our wonderful institutional clients and supporters like you for making this video possible. Please visit our Patreon for daily market updates and live Q&As.